Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
It's not a cyber attack. This is an outage. This is an unintentional type of outage, more of an update-related, reversible type of a problem. It will take probably a couple of days to rectify and remediate that. But I think the straightforward message that it is under control, I think has been alleviating some of the initial concerns earlier.
I still think that we are on a collision course. It's very clear that congressional Democrats want him to step aside, but it's also very clear that the Biden team and Biden himself wants to stay in this race. The COVID diagnosis and the fact that he's home off the campaign trail only restarted this. I do think that, we're looking at a situation where Biden has the delegates, and if he wants to be the nominee, he still has the ability to be the nominee.
Another driver, certainly in the coming years, is the ad tier. We have ad tier members over 30 million this year and then rising to over 40 million next year. Management has said, hey, it's a good entry point for consumers in those markets. So it should be a tailwind to member growth in the coming years.
We've got 1 hour to go until the market close. So let's take a look at the major averages. Not a happy end to the week if you are a bull here. We've got broad selling pressure. And whereas earlier in the week we were seeing the rotation, we were seeing some up and some down, today it's mostly down, at least if you're looking in equity. So right now the Dow is off almost 350 points, 0.9%. The S&P 500 down 0.5%. And by the way, set for its worst week since April, down by 1.8%. And then take to the Nasdaq. Any relief there? It's down 0.6%. Any relief in the small caps? Nope. Down 0.75%, and always sitting at the top of the trending ticker list today has been one stock and one stock only, and that is CrowdStrike, down 13% after a massive outage that has been linked to the company.
Historic outage, not a hack, not a cybersecurity incident, simply a software update that caused this, what's really being described as just this historic outage at this point, Julie.
Yeah, a lot of comparisons being drawn to Y2K and that outage that didn't happen, but this sort of scope-wise similar to what we might have seen at that point, and also connected with Microsoft, since it seems to have come to the various systems that it affected through Windows systems. And when we talk about systems affected, we're talking about airlines, we're talking about medical facilities, we're talking about media, we're talking about banks. I mean, really just a broad swath of the global economy that was affected by this. And we saw it really play out. One of the quick, interesting things that we have been seeing as well is that one of the areas that has been gaining, I said everything's selling off today. That isn't quite true. Bitcoin's
working.
That's an area where people have been going into, looking to, if chaos is happening, if global systems are not working, a place like Bitcoin has been gaining some dollars.
I also wonder how much is that a potential Trump trade as well? I mean, Trump, right now has the edge, just coming off his speech last night at the RNC, and Trump has been actively positioning himself as the Bitcoin candidate.
But I think that additional catalyst here today.
All right, but the top story of the day, a massive IT outage causing chaos worldwide today. Airlines, hospital systems, businesses, and banks all reeling after an update from cybersecurity giant CrowdStrike causing a major disruption. Yahoo Finance's tech editor Dan Howley is here with more. Dan.
Yeah, Josh, this really kind of just comes down to a single update and more or less a single point of failure for this entire internet backbone, basically. Just to kind of give an explainer of how this all seemed to come about, CrowdStrike sent out an update for its software. CrowdStrike is used by a number of Fortune 500 companies, honestly, companies around the globe, clearly. It impacted Microsoft systems. Microsoft is the world's largest operating system for laptops and desktops. And as a result, but a huge number of systems that were running Windows and had CrowdStrike as their cybersecurity provider went down. And so that took offline businesses, as Julie was saying, airlines had to ground flights, hospitals had to cancel procedures. Bankers couldn't get into their systems. I mean, we're seeing those kind of images come in of the blue screen of death, basically that, critical failure for Windows systems. And this all comes down to that single update. Now, why did this all happen at once? Well, some of the experts that I spoke to essentially said, look, cybersecurity is so important. When an update goes out, it points to different flaws in systems that attackers also learn about, right? This is an update goes out, the information is published about it. Attackers aren't dumb, and so they know what the update's fixing. If companies don't apply those updates and fix those flaws, then attackers can go after them. So the updates were applied across the board to CrowdStrike customers, and that's why we saw this huge cascade of failures across various businesses. Now, CrowdStrike says that they're deploying a fix. It's going to take some time for companies to go ahead and actually get these fixes in place. This person at Forrester had said that some IT people have to actually go in manually with plugging in keyboards into systems and fixing this on their own. It's not something that they can just automate. And so it's not something that's just going to go away at the drop of a hat. This is something that's going to take a while to truly remediate. But it kind of comes down to this idea of, there's these individual companies that are relatively small as far as number that power the current internet. And some of the folks I spoke to had said that's this point of failure where you have such a small number of individual companies running something that is so important to modern life. And when one of them does something that makes things go haywire, it just annihilates everything that we use.
Well, it's still going on for some as we continue to see some of the ramifications of this. Thanks a lot, Dan. We're going to continue our coverage of this outage because while the CrowdStrike update is the root cause of the outages, it took out Microsoft systems that were running the program. Joining us now to explain more is Ann Johnson, Microsoft Deputy Chief Information Security Officer and Corporate Vice President. Ann, thank you so much for joining us. I'm sure it is a very busy day at Microsoft. So what can you tell us about sort of, especially for us lay people, about how this sort of percolated through systems and then the process of turning that around and getting everything back up and running?
Yeah, thank you so much, Julie. Thanks for having me on. Look, CrowdStrike pushed out an update last night. This is similar for folks that aren't, steeped in this technology all the time. Think about if you updated an app on your telephone, right? Though this was not a consumer impact, this was largely enterprises who were running CrowdStrike as one of their security solutions to help them be more secure and fend off these large global attacks. And customers who had solutions with CrowdStrike, and it was a global IT outage. We are working really hard. We're working with CrowdStrike. We are having a lot of conversations with them. They have published guidance on their website. I would strongly encourage people to follow that guidance because there's a lot of misinformation, as you can imagine, out there on social media and in different places. And we also have teams of engineers working to make it easier for folks to apply the fixes to this CrowdStrike flawed update. We are working and having conversations with CrowdStrike. We've been on the phone with them all morning. We have teams of engineers, and of course, we have teams of our support engineers working directly with customers to try to get them mitigated and up and running just as fast as possible.
And I'm curious, how long you think this lasts before it's fully resolved? We do see some recovery, but is it hours, days, Ann, or just too hard to say at this point?
Yeah, Josh, that's such a hard question to answer because every customer, these are the largest enterprises in the world potentially, and they have really complex systems. And because CrowdStrike is such a integrated part of those systems, there are times when they're going to have to do manual updates. We are working with CrowdStrike really fast to try to remove all of that manual process and try to get to a place where customers can do a more updated and automated process. But at the end of the day, customers are moving as quickly as they can with the support from us, with the support from CrowdStrike, and we're conscious and empathetic that we need to get global business back online.
And when you have one of the companies that you work with roll out an update like this, what kind of sort of, because I know it happens a lot, they put out updates frequently to try to address all of these threats. What kind of testing happens beforehand, and what kind of conversations are you regularly in with CrowdStrike and other companies like it?
Such a great question. So look, our engineering teams always are working with any of our partners who are publishing security features that impact our systems to try to avoid a situation like this, right? And those are ongoing conversations. There's a very rigorous program where the partner is encouraged to test thoroughly, and I certainly wouldn't in any way anticipate they didn't test thoroughly. This obviously was just something that was unexpected and has caused this global event. And the thing we really need to focus on right now is getting people back up and running as quickly as possible. We are focused with CrowdStrike, with our customers in doing that, and there will be plenty of time post this event to figure out exactly what went wrong and how we can make sure that something like this does not happen again.
And a broader question for you, and I know folks are asking right now about whether we are just too reliant, Ann, on too small a number of companies powering the web. Well, it just seems to be a key issue, a key question folks are asking after this event, and I'm curious to get your take on that.
Josh, I think people ask those questions after any event, right? I think that I've been in tech forever, but I think that we always have to look back post these events after we get, like I said, our focus right now is getting customers up and running as quickly as possible. That's where all of our resources are focused. But post this event, I think there's an opportunity for all of us to take learnings from it and make sure we do better in the future, and that we work incredibly collaboratively with both government and businesses to make sure we have robust ecosystems so we can withstand events like this and they don't have this type of impact.
Do systems need to be more open than they are now, ironically, in order to try to prevent some of this?
You know, that's an interesting framing, just because this was a third-party solution. So it was, by definition, a very open system, right? A third party provided an update to their Microsoft customers that brought down global IT systems. And by its very nature, it's actually a definition of an open system, because this was not a Microsoft law against a Microsoft system. So I don't think that actually is probably the move ahead opportunity. But like I said, the focus right now has to be on getting customers safely and securely back online, getting all these businesses back up and running. There will be plenty of time post the event to think about what's next and how we build more resilience into the ecosystem.
Thanks, Ann. Really appreciate your time today. In the meantime, we're watching shares of CrowdStrike. They are down by about 12% in today's session in the wake of those outages. With more on what this disruption means for the company and others in the cybersecurity industry, we're joined now by Trevor Walsh, Citizens JMP Securities Equity Research Analyst. Trevor, thank you so much for joining us. At the very least, this is not a good news headline day for the likes of this company. So where do they go from here? How do they address this? And is this just sort of a short-term issue, or is it going to be a longer-term one?
Yeah, thanks, Julie. Great question. I mean, I think in this interim period, it's certainly, as you said, pointed out, it's not something that the company wants to happen. But I would point out that in terms of outages caused by cyber tools, maybe on a smaller scope, that's not necessarily an uncommon occurrence. In my prior life, kind of working in industry, we saw this happen quite frequently, especially with endpoint security tools, because of the nature of their access to operating systems. You do everything you can to kind of mitigate those risks around testing before you launch and going into production, et cetera. But clearly there were some, hiccups or mistakes made on this end. So I would commend the company and Mr. Kurtz kind of going on, shows throughout the day-to-day and kind of being very transparent in how they're both fixing the issue itself and looking to work with customers on the go forward. So I think in terms of just the brand reputation, yes, some damage certainly, but I think the company's doing everything kind of above board and as best they can to, I think, help customers through the situation.
Trevor, it's interesting. I saw some of your colleagues on the street who also covered this name saying the timing of all this, though, from CrowdStrike's perspective, is not great, they said, Trevor. The point being, it's happening the last 2 weeks of the quarter, which they pointed out are very important for the company, could limit Q2 upside. I'm curious, just as a financial analyst, how are you thinking about that issue?
Yeah, I think it's certainly one to consider. Timing is everything with a lot of these things, and when you're at that 2-week crunch, less than that at this point for them, that is when you are kind of all systems go of trying to bring in those POs and whatnot, and those types of issues when they come up can, even if it's the customer not acting nefariously or trying to rake you over the coals from a price perspective, that can cause pause around a deal for sure. Again, I think the criticality of CrowdStrike as a security platform tends to, I think, outweigh some of those issues in the sense of, customers can't afford to just turn them off and not renew because of, one incident. They're too tied into the ecosystem. They're too critical of a tool kind of within the overall stack. So I think those conversations certainly have the potential to emerge, but I can see the company kind of, doing what it needs to do to kind of make customers right. Could there be a little bit of noise around the quarter? Absolutely. But I think that's a little bit more one-off basis rather than like kind of a broad-based risk.
Well, at the same time, Trevor, in terms of how the market is reacting, well, if CrowdStrike is down, some of its competitors are up. I mean, we see a gain in shares of Palo Alto Networks. We see a gain in shares of SentinelOne, for example. Do you think some of its competitors will be able to capitalize and take some share?
I think in terms of significant market share type of movements, I don't see that at this point. Could there be anecdotal wins within kind of the immediate, again, next couple of weeks and into the next quarter? Sure, because I think that there are some customers that might either be evaluating new endpoint solutions to kind of net new and have CrowdStrike and SentinelOne, for example, side by side, and maybe this helps to make that decision kind of less favorably in CrowdStrike's favor. But I think that benefits SentinelOne a little bit more versus Palo Alto, just given the scale and scope of those two businesses. And kind of one or two big wins to SentinelOne means a lot more than a single, maybe smaller deal taken away by Palo Alto from CrowdStrike. But I think your former guest, Ms. Johnson, kind of set the tone pretty well in terms of just generally how companies seem to be reacting broadly to this incident. It's more of a team, all hands on deck. Let's just get critical infrastructure, key companies within that use CrowdStrike and Microsoft up and running again. I think companies that would sort of use this as an angle in a real aggressive way might think twice about that. Just again because I think they could very much be kind of in the same boat later down the line.
Trevor, broader question for you. You've seen this kind of trend of consolidation of vendors in cyber, Trevor, and I'm curious whether going forward you think there'd be more scrutiny of that trend, just because maybe some folks think, Trevor, maybe it's better we have more players instead of fewer.
Yeah, and I think that's right, Josh, in terms of at least people taking a look at that priority or that strategy. But regardless, I think that there's the platform strategy and trend from the side of the vendors like CrowdStrike, like Palo Alto, but then there's also the overall take from CISOs and the users where they're not necessarily wanting to consolidate and have a mega monolithic single tool in their environment for the reason that that creates one single point of failure. So I think you have to kind of differentiate a little bit between the marketing speak of the vendors and then the actual users themselves. And to be sure, there's, given where the macro environment is and budgets are, there's definitely, I think, opportunities for tool consolidation, but I don't think we necessarily live in a world where, Microsoft, CrowdStrike, Palo Alto become the singular security tool for these large enterprises. It's just not kind of the way in which I see things heading.
Trevor, thank you. Helpful perspective on this whole situation. Appreciate it.
Thank you.
We're just getting started here on Market Domination. Coming up, stocks are headed for a losing week with another down day in markets today. But with more earnings on the horizon, are we primed to see a turnaround next week, perhaps? And among those companies reporting earnings will be Tesla. We'll speak to an analyst later in the hour about what to expect from the EV maker, especially in the wake of former President Trump's comments on the sector last night. Stick around, more Market Domination still to come.
Markets have pulled back from all-time highs this week and sinking again today. So have we seen the peak of the year, or can we expect a turnaround with more earnings next week and a potential rate cut ahead? For more, let's welcome in Michael Antonelli, Baird Managing Director and Market Strategist. Michael, always great to see you. So got all three indexes in the red here, Michael. As we head into the weekend, what are you telling your clients, Michael, about this market?
Yeah, and it's certainly an eventful month that we've been through. So who's to say Friday wouldn't also be eventful? So we've been talking and thinking about, is this the top? In fact, we just put out a piece of content today to our clients asking, is this the top? And we can look back at this interview a year or two from now. I don't think it is, and I'll tell you the various reasons if you want to dig into those. But we do get pullbacks in the stock market from time to time. It's been a while. I saw some data from Bloomberg that it's been a while since we've had a 2% pullback. And what we're seeing, I think, over the past few days is one of these just like summer doldrum type sell-offs. I don't see anything in the news or in the economic data or anything to support the fact that the top would be in, or that this sell-off that we're having is driven by something in particular. I just think we're in one of these like summer doldrums where the news, as it pertains to the markets, just kind of gets a little bit slow.
Michael, okay, so let's dig into it. Why isn't it the top? And I guess another way of asking that question is, what will further catalyze the rally from here?
There's a couple things I think that are driving stocks right now. I'll just tell you the two or three that I think that are the most relevant here. A Fed rate cut. Obviously, we do talk about that a lot. This was the first bull market in like 50 years to have not started with rate cuts. So a rate cut would broaden it out. I think that's one of the reasons you saw smalls do so well this week. Household balance sheets, sub 3% mortgages, still low unemployment. All those things are still the case. And then rising earnings, like you're mentioning on this show, earnings next week. I just looked the other day, forward earnings, 12-month forwards about 262 now. It just continues to go higher. So earnings, good household balance sheets, rate cuts, positioning. A lot of people are probably underweight smalls. So that's why you saw that big move. Lots and lots and lots of reasons why the market still keeps going. And we're not even talking about AI or GLP drugs there.
How closely, Michael, do you watch sentiment as just a variable? I ask because some of your colleagues, some other strategists say to them, they're looking at certain sentiment indicators and they use words like giddy, Michael.
Sentiment is such a, I wish there was a way to just grasp onto it, right? And just really understand how it affects and how to measure it and how it would affect where we are in the current cycle. It doesn't seem particularly giddy to me based on a couple different things. I mean, certainly there are pockets of the market that can get a little bit over their skis, but why is it not giddy? Well, earnings are going up, rates are coming down. Those aren't giddy things, right? Those aren't just those aren't just kind of, I feel good about the world, let me buy stocks. NVIDIA, which we talk about a lot, makes a lot of money. They have a lot of earnings. So I don't particularly feel like it's super, super giddy. But sentiment, as it pertains to stocks, it pertains to who's invested in what, I think can definitely be worth watching. It just doesn't scream to me that it's really bad right now.
Well, and then, of course, there's also sentiment in the real world as separate from sentiment in the markets. And there, it's complicated. As we were in a pretty contentious political year, I'm curious, Michael, how closely you've been watching what's going on, not just in Washington with the conventions, et cetera. There is, it seems, an increasing drumbeat of speculation that President Biden might step aside as Democratic candidate for president. If that happens, what happens in the market, if anything?
So I spend a lot of my career talking to our clients about the intersection of money and politics. I do it a lot. I say it's like tiptoeing through a minefield, but I have to do it, right? That's what one of my goals is to help people understand uncertainty and how it impacts your money. I will say this. I have had the view or the take all year that the stock market knows everything it can about these two candidates, the two leading candidates right now, President Biden and former President Trump. It knows everything about the two, their policies, and that we've had a lot of time with these two candidates. So that's why I think the market really has kind of shrugged them off. If something changes, right, in the interim, if the candidates shift, which we don't know whether that's going to happen or not, the market will readjust to that new piece of information. But let me say this, because I think this is super, super important. And we've seen it today with this CrowdStrike thing. Markets hate surprises. They don't hate news. They hate surprises, things that completely catch them off guard. The changing of a candidate that people were talking about isn't catching them off guard because we're talking about it right now. So there isn't really a surprise looming. Maybe there is, and I don't see it yet. But as long as we're talking about something like CRE, or that's when the market can come to grips with it and price it in. When it gets caught off guard, like this CrowdStrike thing, that's when the market gets caught flat-footed and things have to shift rapidly.
Mike, I'm just curious, spinning ahead to next week, important economic data point on tap, PCE. I'm curious, Michael, what you're looking for there and how important you think that is for the market.
Inflation is a story for the market, I think, is mostly irrelevant at this point. I really do. I think some of the recent data that we've seen, even when we see hot inflation numbers, right, a little bit above 3, the market has still gone higher. So I think inflation as a story, as a worry for the market, is over. Why? Because we were worried about the kind of wage price spiral we saw in the 70s, or the inflation we saw in the 70s. The market was worried about the tails of inflation. We've clearly lopped those off. So if it fluctuates between 2.7 and 3.1 or 2.6, the market can handle that. So I do think that the Fed has enough kind of cover now with the weakening labor market. It's not as hot anymore there. I think they have enough cover to do a rate cut and not have to worry about inflation. But another take I want everybody to remember, the U.S. economy is not an on-off switch. It's a dimmer, right? It's a dimmer, right? It grows brighter, grows darker. That's how it works. Not on-off switch. The economy's dimming right now, and that will give them the necessary tools to have a rate cut.
Mike, always great to catch up with you. Have a good weekend.
See you guys.
Thanks. Well, a recent entrant on our trending ticker list is Starbucks. Those shares up 5.5%, and that's after a report from the Wall Street Journal that Elliott Management has taken a big stake in the coffee chain. The Journal reporting the activist is privately seeking ways to boost the share price. It's unclear whether Elliott would want board seats, but it's pretty clear to understand why they might get involved here. The shares are down some 18% year to date, even with this little bump up that we're seeing here today, Josh.
Yeah, it's been rough. I mean, remember when Starbucks reported in the spring, in April, you saw weaker than expected quarterly profit and sales cut their outlook. So it has been tough for Starbucks. Some details here. I mean, we're still waiting to see how this shakes out. According to the Journal, again, doing this reporting, they are pushing for changes. It's not clear exactly what. The situation the Journal describes as fluid. Possible they reach an agreement privately. Starbucks does have results on tap. Q3 is coming on July 30th, so maybe you get some more details at that point.
Maybe. Howard Schultz, of course, who was the longtime head of the company, had left and come back and left and come back. He's still one of the biggest shareholders. He owns about 2%, as the Journal points out, of the stock. And the stock has fallen a lot since he ceded the reins to Laxman Narasimhan back in March of last year. So we'll see exactly what Elliott plans to do. Well, let's turn to some other trending tickers that we are watching here today as well. One of them is Intuitive Surgical. The share surging by 9% after they delivered a beat on second quarter earnings, driven by a big uptick in procedures and system sales. Piper Sandler, Baird, RBC Capital, BTIG, they all raised their price targets on the stock, and it all has to do with the Da Vinci surgical robot. That's one of the big products of this company and services associated with that robot. They rolled out a new one, and it seems like the rollout is going well.
Yeah, I mean, investors clearly like this. We're up about 10% right now. I did reach out to Matt Taylor over at Jefferies. I was just interested for Matt's take on this. He told his clients, listen, bottom line, solid print. I mean, he didn't find much to find fault with here. Margins outperformed. He sees the results as encouraging in his words. He raised his numbers and his target. Does remain, though, at a hold for now. That is just on valuation, according to Matt. And the stock is up about 35% so far this year.
Yeah, it's had a run. Now, that Da Vinci surgical robot, we mentioned procedure growth. That was 17%. Placements of its surgical systems rose by 3% to 341. Both of those numbers, by the way, beating estimates.
And we are also watching Dow Component Travelers, the insurer revealing a jump in second quarter profit as higher investment income offset steep catastrophe losses. Lower than expected growth, though, in net written premiums, weighing on the stock here. So Q2 profit beats expectations. The top line doesn't. CEO saying, we are pleased to have generated a strong bottom line results in the quarter that included a record level of severe convective storms across the United States. Catastrophic losses, $1.51 billion pre-tax. They say catastrophe losses primarily resulted from numerous severe wind and hailstorms in multiple states.
It's tough to be an insurer right now, given the weather patterns, given climate change affected weather. And, you have to wonder how the insurers are going to look. We've seen property and casualty insurers pull back from some areas, for example, that were more prone to these type of events. So we'll see how all this plays out.
Yeah, it's tough. And by the way, most analysts agree. I mean, they are on the sidelines on this name. All right, coming up, Tesla is set to report second quarter earnings next week. We're going to speak to an analyst on the other side to preview what investors should be watching out for. Stay tuned, more market domination still to come.
Tesla reporting second quarter earnings on Tuesday after the closing bell, and investors will be looking for any new information about Tesla's much anticipated robotaxi event. But how many people are even using full self-driving in Teslas now? For more, we're bringing in George Gianarikas, Managing Director at Canaccord Genuity. George, it's good to see you. Obviously there has been a lot of focus already on Tesla's margins, on the fact that sales have not been fantastic, not just of Teslas, but of EVs more generally. So let's start there and what you expect to hear from the company.
Hi, thanks for having me. Well, we've already gotten a glimpse as to what Tesla's deliveries were for the second quarter. The incremental news that we'll get from the call will be, as you alluded to, the margin trajectory of the firm, how exactly what appears to be a gangbusters quarter in their energy storage business translated into profits. And really importantly for us is the FSD take rate. Yeah, so if you remember during the quarter, they lowered the price of FSD to about $8,000 if you're paying a license, $99 a month if you want to buy the recurring revenue portion, the subscription, and they also give people a month free. Well, how is that translated into consumer appetite for the product? That's really, really important because for us, before robotaxi even happens, we have to figure out what the consumer appetite is for full self-driving offering that they have available to them today, particularly when that'll help dictate the earnings trajectory of the firm for the next few years before robotaxi kicks in.
And George, do they disclose the take rate for FSD, or what do you watch to sort of extrapolate that number?
We're just going to ask. I mean, they don't disclose it during the call. They have sort of alluded to the backwards math in a couple of quarters ago. So in the U.S., it appears to be that the take rate has historically been probably in the high teens. So every time someone buys a Tesla vehicle, the high teens percentage actually adopt for the full self-driving. It's not a metric that they traditionally give out. So hopefully if we get our question, we'll ask the management team on the call. But like I said, that's really important. Not to mention, they have alluded to the fact that they plan on launching a few new vehicles before the $25,000 vehicle comes out. So people have called it the Model 2.5, so to speak. And so we think that could really help volumes like this year, early next year. So we'll see what they have to say about that. The last we heard about it, I think it was at the shareholder meeting, Elon Musk said he's really excited about them.
I'm just curious, George, as you think about, you mentioned the robotaxi event. One, George, what you think you might see at that event, and two, George, how long before you might see, real meaningful financial impact there?
It's a really good question. So in our model, we haven't built in a robotaxi line yet because we're still waiting to see when it's coming out, what the economics look like, et cetera. Suffice to say that the timing is incredibly unclear. Look, we have robotaxis today. They just operate in limited operational domains. I mean, they're offered by Waymo in cities like San Francisco and Phoenix, and I believe in Austin. But the problem with that particular service is that it's really, really expensive to build their vehicle, right? The Tesla vehicles have an advantage because, according to Elon Musk, they only have cameras in the computer room. But the hidden cost, and we recently put a note out about this, is that the difference in approaches is that Elon Musk is building a massive data center infrastructure to support that, right? So, and he's disclosed that it's cost cumulatively well over $10 billion to build that. So we put out a note that really tries to break down what the cost per vehicle is actually, if you include all the back-end spending they have to put together to enable that vehicle. There's a really hot debate right now in autonomous vehicle circles. What's the right approach? Do you have this neural network approach where you use only cameras and you build this data infrastructure that literally dictates the terms of how that vehicle will drive? Or do you put more sensors on the vehicle? You have some AI, but you also have some hard-coded software rules that will sometimes override what the AI tells the vehicle to do. It's a really big debate. Some people think Tesla will win. Other people think that Tesla is a little bit too aggressive in how quickly they're deploying AI.
George, this is all really meaty stuff having to do with the nuts and bolts of the company. But as usual, there's a lot of noise when it comes to Tesla. And I got to ask you about that noise. We had some commentary from former President Donald Trump. He talked about EVs last night in his commentary at the RNC. And I want to play that for you and get your reaction.
And if you were going to do this all over our country, this crazy electric mandate, if you're going to do this and by the way, I'm all for electric. They have their application. But if somebody wants to buy a gas-powered car, gasoline-powered car, or a hybrid, they're going to be able to do it. And we're going to make that change on day one.
I myself have 2 hybrids at home. George, if we do see a Trump win in the White House, I'm not sure which mandate he's referring to there, but what do you think that's going to mean for Tesla and the broader EV market?
So, look, we've had EV incentives that have come into place after the Inflation Reduction Act was signed into law. And those incentives, assuming that the people who buy the vehicle meet the income requirements and that the vehicle itself is within a certain price range, you can get $7,500 off from a federal tax perspective. The interesting thing is, though, if you look as to when those incentives were put in place, and you look at what Tesla's vehicle sales have done, I'm confident they've helped. Right? I mean, $7,500 off is a lot of money. But Tesla's vehicle sales really haven't grown significantly since the beginning of 2023. It's been part of the issue with the stock. So that really means to us that, yes, it'll definitely have an impact if those incentives somehow are taken away day one. But there's so many other things at play. I mean, if you recall, late in 2022, Elon Musk started to really talk about the impact that interest rate increases were having on vehicle sales. So let's just say in an environment where those EV incentives come off, but rates go down, that may be a net positive for the vehicle sales. So nothing operates in a vacuum. Clearly, that $7,500 going away wouldn't be a good thing, but there's so many other factors here at play that we'll see how it all works out.
George, we're always lucky to have you on the show. Thank you for joining us.
Thank you for having me.
Businesses around the world coming to a halt on Friday after an update from CrowdStrike software took out computer systems running Microsoft's Windows platform. Could this have been avoided, and how quickly is it being resolved? For more, let's bring in Fred Vicola, the CEO of Kaseya. Fred, it's good to see you. Your thoughts, Fred, in reaction to this outage? I'm seeing it described, Fred, as the most spectacular IT failure ever. Is that how you're seeing it, Fred?
It's hard to say. I don't know if I would call anything the most any kind of failure, but it's a challenge. I think CrowdStrike is a fantastic company. They happen to be one of our competitors, but they are an absolutely fantastic company. And what they experienced is what any software company can experience. Technology's become, the world's become reliant upon technology. And making sure systems are secure and always available is what Kaseya and CrowdStrike and other organizations do. It's a nonstop battle against the bad actors to make sure that systems and data are protected and available. That means a constant updating and constant modernization and relevancy making of software products. And unfortunately for CrowdStrike and CrowdStrike's customers, this time hit a little bit of a snag, and it's very disruptive.
Well, and just how disruptive it is, Fred, does that show us that there are not enough maybe redundancies in systems around the globe? And do you think that in the wake of this, there'll be an effort to maybe remedy that?
I think the detail of this specific event, or incident, I should say, has not a lot to do with redundancy. It has to do with some quality assurance and some other issues and some testing issues. But I do think that large banks, airports, all of us, myself included, we've seen people impacted by this. I do think it's going to raise a call for a little more awareness, a little more governance about how companies like Kaseya and CrowdStrike operate. The impact that companies like CrowdStrike and Kaseya have, the net impact is incredibly positive. Without people like Kaseya, CrowdStrike, these systems wouldn't be available because they'd be ransomed and they'd be hacked and there'd be a lot worse things happening. But there is always the risk of mistakes. Human beings do it. So I think this is something that the entire industry, CrowdStrike, Kaseya, Microsoft, all of us, we need to look at and make sure that we're on top of and doubling down on the efforts to avoid any element of a human error.
And Fred, I'm just curious, the criminals, bad actors, rogue states, Fred, when they see an event like this, what do you think they're thinking? Does this in some way encourage them, Fred?
I don't know if it encourages them. What's encouraging, this is going to sound contradictory, but it's encouraging that so many IT departments are investing in technology like CrowdStrike. If we had this conversation 4 or 5 years ago, and companies like CrowdStrike, if CrowdStrike had the similar thing happen, there would be substantially fewer organizations impacted, which would mean fewer organizations were protected against the possibility of data theft and ransomware as they are today. So I think the bad actors around the world are seeing this, and they're realizing that they need to up their game because IT organizations around the world are getting smarter and investing more money in the layers of defense that are required to protect ourselves from these bad actors. So I don't think what we're seeing from CrowdStrike is something that makes the hacking community and the bad actors feel better. I think it's a 1 in a million mistake, and it happens. And I think overall, as society and as an industry, it's a good thing that more and more systems are investing in the money to be protected by technology such as CrowdStrike.
Fred, finally, how long do you think it's going to take for this to sort of play out at various organizations? I mean, everything seems to be mostly back up and running, but do you think that there will be repercussions for a while?
I think you'll see that the tail of this will go for a little while. I think the way most large systems and IT organizations operate, automation is the name of the game. Automation is what prevents manual mistakes and allows massive amounts of work and changes and adaptations to happen quickly. In this particular incident, this is again, a 1 in a million type of an incident. What this is causing is a lot of manual actions to remedy it. So the larger the organization, the longer it's going to take for operations to return to normal because it requires a manual restart and some manual things to be done. But I think, later this evening, tomorrow, I think 95 to 99% of the impact should be remedied. And I think that tail will continue to wean down. And by the end of the weekend, I think just about everyone should be back to normal.
Fred, thanks a lot. Appreciate it.
Thank you.
Stay tuned. We got more market domination on the other side. Regional bank Comerica saw profits and net interest income fall year over year in its most recent quarter. The bank also saying its exclusive deal with the Treasury's debit card is likely to end. Joining us to discuss is David Chiaverini, Managing Director at Wedbush, covering mid-cap and regional banks. David, it's always great to see you to talk regional banks. Maybe not the happiest day for Comerica bulls, though, when you look at that agreement that looks like it's likely to end. What kind of effect is this going to have at Comerica, and kind of how does it push forward from here?
Yeah, so it is an unfortunate development for Comerica to lose the direct express business. So this represented, the bottom line here is that it could impact their net interest income by 165 million is what we calculate, because it represented an average of 3.3 billion of non-interest bearing deposits. So if those deposits, non-interest bearing deposits, are invested in a cash type of investment of 5%, that's where we get the 165 million, and it represents about 15% of EPS. So that's why we're seeing the negative stock reaction today.
I'm curious, David, as you look at your coverage universe and just looking a little farther out, are there reasons for optimism, David? You know, potentially lower rates, maybe changes in administration with less regulation. How are you feeling about it?
Yeah, it's a great question. You hit the nail on the head on both of the key factors. Lower interest rates can help credit quality. It can help ease deposit costs. And then on the political front, if we do get a Trump administration, that could lead to deregulation and potentially an increase in M&A activity. There's been a lot of hand-wringing over the past few years. When deals are announced, it takes a long time for the approval to go through. We think a change in administration could accelerate the time in which it takes to approve a deal and could encourage additional deals to come through.
On the flip side here, what are we looking at in terms of, and I guess these items are sort of agnostic to politics, right? Net interest income and how that looks going forward, as well as loan growth going forward. How are you sort of modeling those two things out?
Yeah, so net interest income and net interest margins, we are expecting them to be kind of stabilizing here in the second quarter and third quarter. The key factor for the driver behind NII is, as you noted, loan growth. And unfortunately, it's the messaging coming from the regional banks this week is that loan growth is tepid and is likely to remain tepid in the near term. And what could accelerate and be the catalyst for increased loan growth is lower interest rates. Loan demand right now is low because many borrowers are viewing the high cost as a headwind to them wanting to take out additional loans. So lower rates could be a very nice catalyst for the loan growth.
Some other picks, David, I want to get your thoughts on. First Citizens is a name I know you like. How come, David? It's had a nice run here, already up about 30% this year.
Yeah, one of the key things with First Citizens that I'm anticipating when they report earnings next week is a potential sizable stock repurchase plan. So their capital levels are among the highest of the regional banks at 13.5% CET1 ratio. They say that they want to get that down to around 10.5% by the end of next year. So that implies they could be buying back stock upwards of $1 billion per quarter, looking out over the next 6 quarters. Now, we do anticipate they'll either announce it with earnings next Thursday or shortly thereafter.
Another bank that you like is M&T Bank, which already reported its numbers. The share's already up around 21% year to date, and they had a pretty positive reaction to the print also. How much more upside do you think they're going to get, and where is that catalyst going to come from?
Yeah, so we're anticipating about 20% upside to M&T. They too announced that they're resuming share repurchases in the second half of the year. They have more capital flexibility, and they did take their NII guidance incrementally higher with the earnings print. And then probably one of the most important things is credit quality for M&T. They announced with earnings that their criticized assets came down in the quarter. And that's been one of the pushback items when I talk to investors is their credit performance. But now that we're seeing this inflection on criticized assets, we think that there is room for upside for M&T.
David, so good to have you on the show today. Have a great weekend.
You as well. Thank you.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it is market domination overtime. We're joined by Jared Blickley to get you up to speed on the action from today's session. Let's start with where the major averages ended the day, down in a word. We've got the Dow off by about 378 points. That's good for a drop of about 1% here. Still, though, the Dow did gain on the week. We should mention was the only of the three major averages to have an up week, up about 0.7%. The S&P 500 down on the day, 0.7%, having its worst week since April, as we pointed out earlier. And the Nasdaq also losing today and losing on the week. It was actually the big loser of the week. Not seeing any relief, as we pointed out, in places like small caps today. That group was down as well. And then wanted to get a final check on one of the big stories, really the big stock story of the day, and that is CrowdStrike falling some 11% after a worldwide outage that sort of was linked to its cybersecurity software, although it was not a hack, was not a cybersecurity incident, but the shares finishing lower by 11%. You know, folks we've been talking with today, including Trevor Wallace over at JMP, said this isn't necessarily going to cost them market share on a large level, but certainly investors today a little bit concerned here. Microsoft, through whose Windows systems this outage seemed to spread, down about 0.75%. Jared, tell us what's going on in the sector level and beyond today.
You bet. First, I want to take a real close and short look at CrowdStrike. I'm just going to paint some simple moving average lines on here. We came down past the 50, but guess what? We hit that 200 right on the nose. If you use candlesticks, it was a precise hit, and then it was bought. So that was a gift for short-term investors. Some of them might be gone already on the close, but some might be holding. Now, for sector action, we have healthcare. That was in the number one spot. That's up 0.5%, followed by utilities. But it was mainly action to the downside here. We got tech. That was worst off, down 1.5%, followed by energy. Financials also down about 1%. But let's take a quick look at the weekly totals here. Energy was in the lead, followed by real estate. And so we did see this resurgence in value and a little bit of the cyclicals. We got industrials up 0.5% right there. But really, it was a week when tech was sold. That was the only underperformer, by the way, too. And you can also see this when we take a look at our leaders. Bitcoin and regional banks were the big leaders. That's for the week. And then for the day, guess what? It's also banks. That would be KRE. Those are the regional banks, and also crypto. That would be GBTC. The worst off today was by far the stocks, and that is the chip index once again. Here's what happened today in semis, and here's what happened this week. Pretty bleak picture, although it does contrast with software just a bit. You do see a little bit less red in there and a little bit of green even. And then if you take a look at the ARK Innovation Fund components, you can actually see a lot of green. So unprofitable tech, small cap tech, that did have its moment in the sun, and we'll see if it continues. We did see all of this resurgence in and interest in other parts of the market, and something we're going to explore in about 30 minutes with you, Josh.
Looking forward to it. Thank you, Jared. For more on the markets, joining us now is Amanda Agati, PNC Asset Management Group Chief Investment Officer. Amanda, it's good to see you. So, you know, we were talking to another market strategist earlier in the show, Amanda, and we were asking him to make sense of these markets, and he said, you know, he really just sees kind of summer doldrums kicking in here. That was his explanation. There was nothing in the data, he argued, to suggest the top is in. Your reaction, what's your response to that, Amanda? You agree?
Well, it's great to be with you. Thanks so much for having me. I'm not sure I would chalk this up to doldrums by any means. I think it's a little bit of an awakening in the broader part of the market here as we sort of hit the halfway point of the year and set the stage for the second half. So I think it's been a very interesting couple of weeks. We're starting to see ever so slightly a rotation in some of the sectors and industries that you called out just before we started chatting. You're starting to see a little bit of broadening. It's very early days. And let me just say the handoff between large to small and mid, and certainly growth versus value, has been sloppy. This relay race has not been a clean handoff, but I think it's what sets the stage for the second half. It's going to be choppy out there.
Amanda, what started as a rotation just turned into broad selling, really, by the end of the week here. And so what do you think is going to get markets back in rally mode, if indeed you think that a broader rally is what awaits us?
I really think the only thing that matters right now is earnings season and the results of earnings reports that are yet to come. It's still very early Some of the reports that have come in have been modestly better than expectations. I think that has fueled some of this rotation. But we're kind of settling in here at the end of the day on Friday, maybe hunkering down a bit for some news that might come over the weekend. But next week is a very big week for earnings reports and earnings results. And I think that could very well be the catalyst to get this market rally going again.
Amanda, what is your expectation for corporate profit growth, not just this earnings season, but for the year?
Well, we're still looking at about 11% earnings growth. That's a consensus number, by the way, for all of this year. If you back out the top 5 or 7 names, that growth rate falls to about 7 or a little bit more than 7%. I do think I'm a little suspicious about that 11% number. So I do think that there are some negative revisions yet to come in the second half of this year. And it's really important to see where earnings growth kind of ultimately lands, considering we're still sitting at price to perfection valuation levels. So I do think there's some room for it to come down. But really the key is what happens with financials, healthcare, and industrials in the second half. Those are the ones that are going to keep the lights on this earnings growth trajectory.
And are those the areas that you would be buying right now?
Well, I'm not sure that I'd be backing up the truck and buying them necessarily just yet. There's certainly a valuation opportunity, but I think from a revisions perspective, we haven't seen that inflection point yet. And that's why I'm saying I think the key in the second half is really to start to see some signs of life in those particular areas. We can't just assume that tech is going to lead the charge here and communication services is just going to continue to lead the charge at these valuation levels. The earnings chops are strong, there's no question, but there's just not a lot of headroom to keep this market rally going without some broader base participation.
Amanda, I'm curious, how many questions are you getting from clients about the election, and what are you telling them?
An infinite number of questions. Besides the deficit and debt levels, it's the second most popular topic for sure in terms of our investor base. And, you know, despite what may or may not happen over the weekend, I think it could catalyze some short-term noise for the market, but really what the market really cares the most about in terms of election outcomes is the makeup of control. Is there going to be a change of control? Is there going to be a sweep of one particular party? The best performing market environments tend to be where there's divided control, and it's really because the market believes they can't do too much damage in one extreme or the other. So at a time where there's kind of a volatile backdrop, maybe Washington might not be quite so volatile.
We'll see. Fingers crossed. Amanda, thanks a lot. Good to see you.
Thanks, you too.
Coming up, pressure mounting for President Biden to bow out of the 2024 election, what Amanda was just referring to. Perhaps we'll discuss what could come next when market domination overtime returns.
Welcome to Stocks in Translation.
I'm almost always of the school that you buy high, sell higher.
Our essential conversation cutting through the hyperboles.
When the horse gets out of the barn, you have to go chase it.
The market mayhem.
You know, are you bullish or are you bearish? What is your target?
And the noisy numbers.
Don't fight Papa Dow.
Time now for our word of the day. This episode happens to be brought to us by the number 2. Eddie, who is wearing the DeFi mantra better? Is it Solana or Cardano? To give you the information you need for your portfolio.
There are a lot of ways to invest where you don't have to extend yourself and try to hit that home run.
You're going to find that technology was a leader and an outperformer in pretty much every single one of them.
Do we get the follow-on participation?
That's the big question, and maybe Jay Powell will help us with the little rate cut.
Watch Stocks in Translation here on Yahoo Finance at noon on Tuesdays and Thursdays, and listen to us on Apple, Spotify, iHeartRadio, or wherever you get your podcasts.
The pressure is ramping up on President Biden to end his re-election campaign. And in his latest column, our own Rick Newman highlights that Biden is risking becoming irrelevant. And Rick joins us now. Irrelevant, Rick.
That is almost the way the political world is treating Joe Biden at this point. I follow the betting odds, the average betting odds at Real Clear Politics. They're saying 60% odds Donald Trump ends up being the next president. Only 6% odds that Biden becomes the next president. And guess what? Kamala Harris, 21% odds. So Kamala Harris, the betting markets are saying 3 times as likely as Biden to become president at this point. He has been enduring some epic disses. The big one this week was the president of the Teamsters Union. Teamsters endorsed Biden in 2020. And Biden has done a lot for unions. I mean, actual legislation and policies. He showed up and praised Donald Trump, the president of the Teamsters Union, during the this week's convention. He said, that doesn't mean I'm endorsing Trump, but he is sort of saying to the rank and file, yeah, you can fine if you vote for Trump. That is a real burn for Biden. And of course, at the moment, he's isolating with COVID, as there seems to be like a parade of Democrats. Just more and more people saying, dude, you need to withdraw.
I want to go back to the odds markets for a minute because they are a measure of sentiment at any given point in time. Do they have any predictive power at all? Have they in the past?
I don't like the prediction markets in terms of their predictive power, but polls aren't great either.
Right.
What they do tell you, they'll tell you trend lines. So if you look at what's happening now, Trump is up, but more important than Trump is up, Biden is down. So that is how investors, to a large extent, are reading the state of the election at this point. And that does affect, I mean, we've been talking this week about the Trump trade. It's here now, right? And the reason that the Trump trade is here is because investors think the odds are growing, not only that Trump will win, but that he will win with a Republican sweep, which means he will be able to pass partisan Republican legislation.
I want to double barrel this last one. One, I need an update on the Rick Newman probability that Biden does withdraw, where you're at right now. And 2, if they did, I'm interested, Rick, let's say Biden does withdraw, who do you think poses the biggest competitive challenge to Trump? Who would you say?
I think odds of Biden withdrawing are 85%. Wow. I think the mere fact that there's so much discussion about Biden withdrawing, I think is becoming a fatal liability to him. And he has brought it on himself, unfortunately. He has demonstrated, as Nancy Pelosi framed it, we all want to know after the June 27th debate, is this an episode or a condition? It is a condition because he has continued to flub. I mean, it's almost as if every interview he does, he has been doing more of these live interviews, and we are continuing to see the flubs. I mean, he gets the details of his own policy wrong on rent control. He forgot the name of the defense secretary and called him the black man.
Yeah, that was
It's
brutal.
Lloyd Austin.
Brutal.
So he is kind of advancing his own narrative of fragility is what he's doing. If there's a replacement, I mean, Kamala Harris is the odds-on heir apparent without a doubt, and it would take somebody within the Democratic Party who really wanted to create chaos by challenging her, because the party, I mean, still does have some unity. There are still people running the party. I mean, Biden is obviously there, but Chuck Schumer, Nancy Pelosi, I think, is a huge force behind the scenes. Probably Barack Obama also to some extent. If Biden withdraws, I mean, they want this to be as seamless as possible. So whatever internecine warfare we have, that doesn't last very long and doesn't interfere with trying to beat Trump. I mean, if you're fighting among yourselves, you're not taking on the other guy, and that's the most important thing for the Democrats. So I think they will try to make it happen. The question is there some rebel who says, no, I'm going to challenge Kamala Trump? We have been gaming this in our planning sessions here, and it's hard to figure out who that person might be. I don't think it would be Gavin Newsom. I don't think it would be one of the Rust Belt governors. I don't think it would be a cabinet member, a Biden cabinet member. Is there some outlier? You know, there's Dean Phillips, I guess, who could say I want it. But so I think then it's Kamala Harris, and then she gets a fresh start, and then we find out what kind of campaigner she is. I have no idea. If she was not great in 2020.
Right. And who her VP is.
And who her VP. But, you know, that's interesting for a couple of days, and then nobody really cares who the VP is.
Right.
But
we might have to get a new
Joe Biden is not this happy guy. right now.
All right.
He's not the happy guy.
Thanks a lot, Rick. Have a good
Thanks,
weekend.
guys.
Appreciate it. And be sure to check out Yahoo Finance's newest podcast, Capital Gains. It's debuting today on Yahoo Finance or anywhere you get your podcasts. And it features our own Rick
Thanks
Newman.
for the promo.
Meantime, on the Republican side of the race, former President Donald Trump, of course, accepting the Republican nomination last night, not only promising to cut taxes, but also lower inflation.
We have an inflation crisis that is making life unaffordable, ravaging the incomes of working and low-income families, and just simply crushing our people like never before. I will end the devastating inflation crisis immediately, bring down interest rates, and lower the cost of energy. We will drill, baby, drill.
Joining us now, Douglas Holtz-Aiken, American Action Forum President and former Congressional Budget Office Director. Doug, I don't know where we got to unpack some of the stuff that former President Trump was just saying. They're cutting interest rates to slow inflation. I don't know. That sounds a little Turkish to me. But tell me what you made of what former President Trump had to say.
Well, I think if you look at the Trump-Vance economic policy platform, you see some things that are very traditional Republican policy, low taxes, low regulation, a reliance on small businesses, things that you've heard a lot from the Republican Party about over the many, many years. You see some other things that are fairly radical departures, support for lean and con style competition policy, something you probably didn't expect to see. Certainly a continued evolution of the restraint on international trade, his 10% tariff proposal being the most dramatic form of that. So those things are very different. And, the promises of the outcomes. We're going to lower inflation and cut interest rates. Well, certainly if inflation goes back to 2% target, we all know the Fed's going to normalize interest rates. That's to be expected. I think that ball is more in the Fed's camp than it is in the Trump administration's camp if they are elected. The question is, will they actually be supportive of what the Fed's up to? The Biden administration is running $2 trillion deficits at full employment. That's nobody's help for trying to get inflation down and help the Fed. The Trump track record on the budget in his first term was not very good. And he's talking about cutting the corporate rate and not touching Social Security and Medicare. And how does it add up? I think that's the big wild card from the inflation front. We know what the monetary policy is going to be. We haven't a clue what the fiscal position is going to be. And the fiscal position is a really important part of the policy mix on both inflation and the long-term growth.
Doug, you touch on an issue that I think is just so interesting, which is how the Republican Party is changing, Doug. When I was growing up, the Republican Party, it was Reagan and Kemp. It was my dad with his copies of National Review around the house, right? That was the Republican Party. Now, as you touch on, Senator Vance or Hawley or Rubio, you hear it's economic nationalism, it's domestic manufacturing, forget free trade, it's, China is an adversary. Is there a way to sort of bridge these economic views, Doug, traditional conservative and populist conservative?
I think there's a lot of it that really isn't that new. So, go back literally over 20 years and George W. Bush imposed tariffs on steel products to protect the domestic steel industry. So that's not new. And by the way, it doesn't seem to have worked very well. So, but we see more use of tariffs on the strategic trade side, China being one where I think pretty much everyone has bought into the notion that we're going to use that as a strategic tool against China. What's really different is a 10% across the board tariff proposal. We haven't seen that. Is that something Republicans broadly are prepared to embrace? I think the jury's still out. It seems to me that you need legislation to do that. I know there's some people think you might not. Would that go through the House and the Senate? I think that's a really big question because that's a $3 trillion tax increase over the next 10 years. How much has the party changed? Will it embrace that?
Well, and I think, Doug, that Josh touches on something interesting here, which is is the Republican Party agenda, particularly on economics, but really across the board, recognizably Republican at this point, or is it just Trumpism? Does it need to be called something else? It seems to be sort of redefined here, and what are the implications of that?
Yeah, well, I'm not the communications director, so I think you got the point for trying to brand this. As I said, I don't think it's recognizable as traditional Republican policy, but I don't think it's an entirely new brand yet. There are these elements that exist. They reflect something that I think is real and new, and that is a far more inward-facing Republican Party, one that is not far more isolationist in its foreign policy views, one that is far less committed to defending freedom around the globe and using the power of the American economy and military to do that. That's really different, and that's really important. A lot of the economic policy changes, I think, are more evolutionary than radical changes. And the question is whether they will survive the next 4 to 8 years or not. The reality is, if you look at the deficits and the debts, you can't do nothing. So far, there's no commitment to doing something, but circumstances are going to force the hand of whoever's governing as much as their policy platform is going to drive it. So we'll see how they react to the circumstances.
When you say circumstances will force it, Doug, what are those circumstances you're mentioning there?
January 1, 2025, the debt ceiling comes back. And suppose Republicans control the House, the Senate, and the White House. Will they casually, easily pass an increase in the debt ceiling or a suspension? Something that all the rating agencies are going to be watching carefully, because the last time we tried to do this, it was a major political football, and there was a downgrade based strictly on the inability of U.S. politics to manage its finances. Will Republicans be able to manage the finances? What happens with funding the government? Probably won't be done by then. What do we do with the 2025 revision to whatever we get out of the 2017 tax cut sunsets? Those are three big, important circumstances that are going to happen in the first year. How will they handle them? Something's going to have to be done in each instance. What will it be?
Doug, literally nobody's talking about this except for you. Not literally
I'm
nobody.
aware of this.
Very few. It's sort of interesting how little people are talking about it, how little voters seem to care. I mean, we were just talking with a strategist earlier who said she's getting a lot of questions from clients about deficits.
I heard that. I was excited.
But I'm sure that you were, but it's not something that's really been talked about. Like, why do you think it's not talked about? Is it just too difficult of an issue to address?
First of all, these are very difficult policy issues. I mean, the centerpiece are Social Security and Medicare, which are 36 out of $71 trillion of non-interest spending over the next 10 years. So that's the bulk of the money. Those two programs, they're complicated, they're important, they're very, very big, and they're growing faster than anything else. So if you want to deal with the U.S. budget outlook, you have to deal with Social Security and Medicare, and both people running for president have said they're not going to touch them. So the reason no one's talking about it is the people at the top have sent the message, we're not doing anything about it. But if the markets wake up and the rating agencies wake up and say, look, you can't even raise the debt ceiling, you can't fund the government, what are you going to do about these really big problems? That's going to change that conversation. They're going to have to come up with real efforts to bring in bring the spending growth down and make things add up.
Doug, thank you so much for joining the show today. Appreciate your time.
Thank you.
Time now for what to watch next week. Earnings season really does heat up. Big tech earnings coming in throughout the week, and all eyes will be on Tesla. The EV maker is announcing second quarter results after close on Tuesday. Investors are going to listen for any updates on the company's delayed robo-taxi event. Also on Tuesday, Google parent Alphabet will report second quarter earnings after the bell.
And taking a look at the economy, personal consumption expenditures data, PCE, the Fed's preferred inflation gauge, that's coming out on Friday. Economists forecast both overall PCE and core PCE will tick up slightly. The new June print will be another key piece of economic data as traders look forward towards September for a potential rate cut.
And finally, we'll be getting some more corporate earnings next week, including Visa, Verizon, and Coca-Cola, among others. Coca-Cola reporting on Tuesday. Analysts expecting the company to post slower organic revenue growth for the second quarter.
That'll do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. The worst IT outage in history. Businesses around the globe thrust into chaos after a CrowdStrike software update gone awry sparked worldwide outages today. Airlines, banks, and healthcare systems all scrambling to navigate down systems. We'll hear from a hospital administrator. It's coming up next. Plus, another day of declines across the board. The Dow closed more than 300 points lower as the S&P 500 and Nasdaq both closed out their worst weeks since April. And we're wrapping up Yahoo Finance and Media Week with a deep dive into content. Names like Bridgerton and Baby Reindeer drawing in millions of new subscribers to Netflix this past quarter. We're going to talk to an industry insider about the state of streaming and content later in the hour. CrowdStrike CEO and founder George Kurtz issuing an apology for the global IT outages sparked by a software update, writing, quote, "I want to sincerely apologize to all of you for today's outage. As we resolve this incident, you have my commitment to provide full transparency on how this occurred and steps we're taking to prevent anything like this from happening again." Hospitals are just some of the businesses affected by the outage. Appointments were canceled and delayed procedures. Joining me now is Dr. Marshall Runge, Michigan Medicine CEO and University of Michigan Executive Vice President for Medical Affairs. Marshall, it is good to see you. And maybe we can just start right there, Marshall. Walk us through the impact this outage had on the hospital.
Well, thank you, Josh. We found out about 1 a.m. today that many of our systems in our hospital were down. We didn't know exactly why, but we were able to respond immediately. We have a command center protocol largely set up to respond to cyber attacks, which this was not. And our full IT resources got deployed, and we started then and continued to address the issue. Fortunately for us, we've not had any widespread cancellations. As you just stated, this outage resulted from a recent upgrade in this program, Cybersecurity, which we and, well, obviously it's used broadly, but many in healthcare use as a top-of-the-line protection against cyber attack. And it's a big part of our cybersecurity infrastructure. For a couple of comments. So we always prioritize and have prioritized our response first to any systems that could possibly have an impact on patient safety. And those were restored very quickly. Then we have a whole bunch of functions that are essential for a large healthcare system like ours to proceed. And I'll give you an example of that. For example, we have large devotion to imaging, radiology imaging, and other imaging, and the outage from CrowdStrike resulted in disconnecting our imaging from many of the software programs that are used to help process imaging, help process reports. And that is still the case. However, our radiology staff has been able to continue imaging and having to do manual reporting rather than having the benefit of a bunch of the automated reporting that we have. But those kind of processes were number two. We also have just the basic problem that our staff and faculty and others initially did not have any connectivity to Microsoft functions in their computers. That one's pretty easy to fix, although I'm not an IT expert. But that one's pretty easy to fix. But the scope is very large, about 35,000 users. So in our case, we have had delays. We've had very few cancellations. Many of our processes are now up and going fully. We don't know. I think it's hard to predict exactly when everything will be back online. That could be as long as 72 hours. And it's not all a bad thing that this happened on a Friday, because like all healthcare systems, we have fewer patient visits and we have fewer procedures, fewer surgeries over the weekend. So we hope to be fully caught up pretty quickly.
Does it, and that is good news, Marshall, and we're glad to hear it. I am curious whether, as the CEO, Marshall, an event like this, does it make you rethink, reconsider the software and systems you use?
Yeah, this is it's a challenging issue. We're totally dependent on software, and a software like CrowdStrike, it's ironic. A software we have in place to prevent cyber attacks resulted in knocking out a lot of our systems because of that upgrade that you mentioned. So it has caused us to think about our strategy. And for example, we will, after this incident is over and we've recovered from it, we'll be looking to see, are there areas like CrowdStrike that are software that is used very, very broadly? Because those, although this wasn't a cyber attack, one can imagine that might be a target for a cyber attack. And we fortunately have learned a lot as we have prepared for a cyber attack, but we need to be sure our backup systems are adequate. So, for example, electronic medical records, fortunately, we have not had a major attack on that here at Michigan Medicine, but others have. And we don't have the paper medical records that we used to have. There's no way of finding them. So we lose the ability to review what has been done with patients or to document what's going forward. So we are trying in every way to build redundancy into our system.
Yep, got it. Marshall, it is good news, and I'm glad to hear that most of those systems are back up and running, and we thank you for joining the show today.
Thank you, Josh.
Businesses around the world are doing damage control today. Cybersecurity firm CrowdStrike's software took out computer systems running Microsoft's Windows platform. Yahoo Finance's Julie Hyman joins us for more on that ripple effect. Julie.
Well, you guys were just talking about the effect on the medical system here in the United States and around the world, with a lot of elective procedures being delayed, postponed today. We saw really the ripple effect from the outages pretty broadly here. One of the most visible ways that we saw them take place was within the travel industry. A lot of anecdotes, a lot of videos coming out of airports around the world where lines were really stacking up as a result of these outages. And this is just one snapshot. This was as of 2 p.m. today, with 777 canceled Delta flights just for one airline there. And by the way, Endeavor, which is listed here, is a subsidiary of Delta that flies regionally. So that's another hit there. And then between United and American Airlines, another 700 plus airlines also canceled. So this is, again, just one measure of the sort of congestion that this all caused. Should note as well that this really was a global event, not just here in the United States. Also listed on this KLM, of course, the Dutch airline, Turkish Airlines, Ryanair, Vueling Airlines, which is a discount carrier out of Spain, all of them also experiencing these outages. Another way of getting the snapshot of the timeline of these outages, this is Down Detector, which does monitor outages, again, around the world in terms of internet access. And you saw a spike actually starting last night, then it came down, and then we saw a climb again this morning as the outages continued. As we've been hearing from various sources, most of this is sort of resolving itself here. Planes are flying again, for example, and we are seeing connectivity back up and running. But we are also hearing from some sources that some of the repercussions from this are not going to be done by the end of the day, that it's going to take a while to resolve some of these issues, Josh.
All right. Thank you, Julie. Coming up, today's market takeaways on asking for a trend that is on the other side. Stocks retreating today, the Dow dropping more than 370 points, though managed to close positive on the week. Meanwhile, both the S&P 500 and the Nasdaq marked their biggest weekly losses since April. I'm joined now by Yahoo Finance Markets and Data Editor Jared Blickery. Jared.
All right, let's add it to the data here. Rotation. This was a week of rotation. Yeah. It actually started last week, and we're going to go over a couple different time frames, but I'll show you what happened this week. And really, it kind of got started last week, and where are we looking for our market rotation? We're going to look for that in our leaders, and I'm going to show you the 5-day total here. At the very bottom, chip stocks got whacked, and this is just a 5-day total. Bitcoin in the forefront again, had a nice weekend there. KRE, that is regional banks. Suddenly, the mid-sized banks, those are back in favor. It has to do with the yield curve. The yield curve has been expanding, or it's a little bit less inverted than it was. Home builders up. Small oil, small caps, and when you flip it over to an 8-day view, this goes back to last Tuesday. For whatever reason, it began last Wednesday, the day before the inflation print. You see these basically the same names, but more extreme. The chip stocks are down 9%. Look at the Mag 7, down 7.5%.
Yikes, yeah.
The Nasdaq 100 kind of shows you the entire picture here.
Mag 7, when do they take the lead again? When do they take back the baton?
You know, Tesla reports next week. I think it's going to be all about the earnings. That's going to be one of the big ones. Of course, what the Fed does, but I don't think we're going to see a lot of surprises there. Probably going to cut in September, do nothing in July. I think it's all about earnings right now. So we got Tesla next week. We got most of the other ones the week after. NVIDIA, though, that's kind of the key one. That's not for a month, so it's going to be a little while. But we're going to see that play out over the next few weeks here.
All right, Jared Blickery, point number 2.
All right, let's take a look. Yeah, it looks like we got to find our way back. All right, rotation to cut or not to cut. And this kind of gets to what the Fed is going to do. I just said I don't think they're going to cut in July. Nobody really does, but a lot of people think they're going to cut in September, and that seems to be what they've been trying to angle for. What I looked at historically, this covers.
Now that's a chart.
This is a chart. Yeah. Let me break this down. So we have a dividing line here. If you were to take the price action of stocks around every single recession going back to the 1950s, and this is the price action before, this is a price action after, you can see a difference in support. You can see a difference in performance in stocks, whether or not there is a recession based on the Fed rate cuts. So when the Fed cuts rates and there's no eventual recession, that's a good thing. That means there was no surprises. And not surprisingly, this orange line is what happens to stocks. They tend to go up after that first rate cut. A lot of people think rate cut is always good. That's not the case. Because what happened in 2008, or actually 2007, what happened in 2000, we got rate cuts, but then it led to a huge, huge recession. We had the dot-com bust, and then we had the global financial crisis. What happened then? Stocks went down. And so that's what we're seeing right in here. So depending on whether or not we have a recession, that's going to decide whether or not the rate cut actually helped. Now, the bad part is we don't know when we're in recession until a government agency or affiliated with the government tells us. That's the National Bureau of Economic Research. And they won't do that for a long time, even after the recession is possibly over.
Important to note as you do, Jared, the bull steepening we see today, different than the bear steepening a year ago.
Good point. So I talked about the steepener, and that's favorable for financials. That's where you have the 10-year is a little bit less steep than the 2-year right now. A little bit less. So this is in a marked contrast to the situation we had 1 year ago. So right now we're in a bull steepening. That means that rates are going down, but that means that people are pricing in rate cuts. So people are trying to get ahead of what the Fed is going to do. What people were pricing in a year ago, that was real growth. That was on the back of an economy that was booming and was still on the upswing. So what's happening today, slower growth. What's happening a year ago, that was faster growth.
All right, final quick. Jared Blickery, takeaway. Let's hit it.
Oh, whoa. We were just there, and then we lost it.
Got so excited because you were talking about the red metal.
Well, you were asking for a trend, and here we are. Dr. Copper, give me the news. I've been waiting for this one. So real quick, copper has been crashing. It's not quite in a bear market, but if you're paying attention to the news recently, you might say, wasn't it just hitting all-time highs? And we're looking for HG equals F right here. We'll see if we can find Dr. Copper. Even if I can't, I'm going to show you it's off about, there we go, it's down 6% over that time frame. Here is the year-to-date chart. Here is a record high. we just crashed through an important level. And so what does this tell us? You know,
what is the red metal telling me?
All right, so what copper is telling us is that we should be a little bit cautious right now. So growth is slowing, and we're not seeing copper react to favorable economic news. This is a chart, funky chart that goes back to 2005, 2006. All this is showing is that stocks might keep going down at or might keep going up at a slower pace if we hit this copper to gold ratio. Don't have time to get into the wonky mechanics of it, but Dr. Copper flashing warning signs.
Just study the chart. Thank you, my friend.
You bet.
Appreciate it. Netflix surprising the street by adding more than 8 million subscribers during its second quarter, almost double what analysts were expecting. That surge attributed to password sharing crackdown efforts and popular shows like Bridgerton and Baby Reindeer. Michael Hirschhorn, founder and CEO of production company Ish Entertainment, joining us now as part of our Media Theme Week. Michael, it is great to see you. Let's start there, Michael, with Netflix, because it's interesting. When we talk about Netflix, we talk about the streaming market. It's almost discussed, Michael, like there's sort of Netflix and then everybody else. What is Netflix doing different, Michael? Is it the data, the content? Is it the scale? Walk us through it.
Well, I would say that Netflix is reaping the rewards of a clear strategy that they put in place 15, 20 years ago and that they've been consistently pursuing ever since. You know, for a lot of the other media companies, they're half in cable, they're half in streaming. It's not super clear what their strategy is. Netflix has been laser focused, you know, from really the beginning of the streaming era. And therefore, you know, they are able to have a model that allows them to monetize their viewership. There are other successful streamers, but they're struggling to monetize in the same way.
I'm interested, Michael, you know, as somebody, listen, you're developing and selling these projects. When you think about the future of streaming, you know, as a business, Michael, do you see consolidation? Do you see bundling of streaming services? What's going to be the trend we should watch for?
Well, I think that the trend that is not discussed all that much, that I think is pretty important, is the retreat from what's called SVOD, which is subscription video on demand, and the move towards what's called AVOD, which is advertising video on demand. So Netflix and some of the other platforms have been pushing their subscribers away from a paid subscription model to what has become a more lucrative advertising model, which should sound familiar to people because it's kind of the same model that existed in cable. And what is also changing is that you have the rise of services like Tubi, which is owned by Fox, that recently showed a really significant jump in its share of total TV viewership, which is getting younger audiences. It has, you don't even have to register. You just click on it and you're watching it. And increasingly, I think there's going to be a kind of horseshoe where TV viewing returns to something that looks sort of familiar to the way it did before the streaming era, except with these massive on-demand services.
I'm interested, Michael, as somebody who is, you know, developing, selling content. What is the hot content right now, Michael? What do buyers want?
Big celebrities, true crime. So if you want to succeed, maybe go out and commit some kind of horrible, heinous crime.
And be a celebrity. If you can fuse the two,
and be
now
a celebrity.
You got something. Yeah.
That certainly helps. We had a crime show featuring celebrities that, or at least alleged crimes, and it was the #1 show globally on Max last month. So we were like, okay, let's just keep doing that.
Michael, I wish we had more time, but thank you for joining the show today. That was great. Appreciate it.
A pleasure.
Stay tuned. More Asking for a Trend right on the other side. Move over Adidas and Dr. Pepper. There's another brand that's having a moment. Lincoln landing on Ad Age's America's Hottest Brands for 2024, and it's partly due to this new Nautilus commercial. Senior autos reporter Pras Subramanian is here to break it all down for us.
We missed the din 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 din.
I was locked in. I need that car now. I need it. I'm sold.
Yeah, you're sold, right? So basically, this Lincoln Nautilus, it's sort of like their mid-size SUV. Nothing crazy, nothing special. Lincoln kind of known for an older generation of buyers, but for whatever reason, this car sort of hit a chord here with Americans. It's a very tech-laden car, huge widescreen display inside the car. A nice design here, but I think you just heard one of the reasons why this car's getting some buzz. Online, social media people loving this song for some reason. It's caught on social media people playing it. In fact, Lincoln told their agency to make an extended version of the song. It's called Kaleidoscope Bliss. It's the name of the song. So they made an extended version to put on YouTube and kind of getting some buzz. But the car, for some reason, kind of hitting a sort of a moment here with Ad Age sort of decided what 20 brands were big, like Simone Biles, Cheez-It crackers, NVIDIA chips, right? Adidas Sambas everywhere, and the Lincoln Nautilus.
That is how much is this going to cost me?
So that's around $50,000. So it's not cheap, but you can get it in hybrid form.
I've seen worse. Yeah.
You've seen worse. Hybrid form, probably get a good lease deal. So it's kind of a car that maybe you wouldn't expect younger buyers to go for a Lincoln, and here they are.
That's wild. And we chalk that up, and maybe just it really comes down to like marketing, the commercial, the song, it's social media.
This is Serena Williams. I guess she's a new sponsor or kind of endorser for the brand, and she's very popular.
Serena Williams behind it. Okay.
Was Lincoln spokesperson. Yeah. So that's sort of a combination of things are giving Lincoln a moment here, and I think that's what's surprising most people is how is this happening, and it's happening.
All right. So you know what? The Pras Lipton test drive.
Well, we got to hear the song in. And that's what we're here for. So.
Thank you, Pras. Appreciate it. All right, that is a wrap on today's Asking for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.